You're welcome back to the marketplace. Now to our very first story. The country's debt stock has reached 142 billion Ghana cedis. Figures released by the Bank of Ghana showed that in just 1 month, from November to December 2017, the debt numbers shot up by 3.5 billion cedis. But why are these numbers increasing despite all the programs implemented to reduce the debt stock? There's more in this report.
The reports show that the debt numbers are still going up significantly despite assurances by government that the numbers would be going down or the rate of increase would reduce because of several policy measures being instituted. Loans secured from outside stood at $17 billion, representing more than half of the total debt stock, while domestic was 66.7 billion cedis. For some, the fact that the debt-to-GDP ratio has also reached the 70% mark raises a lot of questions about its impact on our ability to pay debts back on time or being classified as high risk of debt distress. The data released by the central bank also showed that the country's exports earnings appears to increase, with February numbers at $2.8 billion, which is $2 million more than the same period last year. On the banking sector, the reports show that all is not well in terms of growth in all the indicators, while stock of non-performing loans is still going up.
Meanwhile, Deputy Minister of Information Kojo Nkrumah is downplaying the situation. He says government is swapping cheaper long-dated for short-dated debts and relatively expensive ones. He was speaking to George Wiafe in an interview.
So my first question is that I look at the debt numbers and people are saying that, okay, it is rising. What has happened to all those policies, debt reprofiling and all those measures the government was putting in place to see the situation improve or go down significantly?
The government introduced two key measures in the debt management program. One, to reprofile the old debt so that its cost and its refinancing risk will be reduced. So what you have seen in some of the instances that we have swapped cheaper, longer dated debt for expensive, shorter dated debt. The impact is that in the future on our fiscal tables, how much money we have to spend on debt servicing will not go up by the projected amount because now we've swapped it for cheaper debt. What that means is that it will create more space for us to spend on the priorities of government. And on that side today, if you notice, the rates for the shorter dated treasury bills are all falling because government is no longer demonstrating an appetite for it and is literally retiring those ones. So the reprofiling has worked. And we have always mentioned that the reprofiling will not add to our debt stock. Now, the second thing that government also sought to do was a combined strategy of reducing the rate at which we are accumulating debt, reducing the deficit, and at the same time introducing measures that push the GDP up, so that at the end of the day, when you have a lower debt growth figure, the debt stock will not grow by as much as it was traditionally growing. We are slowing down the rate at which the debt stock has been growing, and we are growing the GDP faster. So that is why now when you do the debt to GDP ratio, it has dropped to 69.8%. Our hope is to do more of it so that we can get to a medium-term target, hopefully about 65%.
What do you think for the layperson on the street, he wants to look at the nominal numbers and ask himself, why am I not seeing that significant reduction in the nominal numbers?
In the debt stock, you mean?
Yeah.
And we have to help the layperson by understanding that if my salary is 4 million and I owe 3 million, I'm at a risk of debt distress. But even if my debt goes up by 200 cedis and now I owe 3.2 million, but my salary now goes up to 10 million or 15 million, I'm no longer at a risk of debt distress. And that is why the economists never just limit the conversation to the debt stock, but they always say it is measured by the debt to GDP ratio, because that is what compares your debt stock and what it has been used for. And that is why they say that when you cross the 70% threshold, then it means that the debt you are accumulating is really not generating enough GDP, and therefore you are at a risk of distress. In this case, if you compare the two, we have come down from 73.3% now down to 69.8%. And we're hoping to take it down a bit further. So if you ask me about the layman, I'll say our challenge is to get the layman to understand that actually the debt sustainability graph is improving, is coming down.
And now to one of our top stories. The Monetary Policy Committee of the Bank of Ghana has reduced the policy rate by a significant margin. The Bank of Ghana dropped its key lending rate to commercial banks by 200 basis points to 18%. The cut is the biggest drop in the policy rate since November 2014. Addressing journalists at the MPC press conference a while ago, the governor, Dr. Ernest Addison, said the move was influenced by positive economic outlook.
The continuation of the allotment system, which aligned expenditures to revenues. Growth prospects for 2018 remain positive and are expected to be supported by crude oil production, gradual recovery in non-oil sector, and favorable business and consumer sentiments. The pace of growth in economic activity, as reflected by the latest update in the CIEA, showed some improvements, although still below potential for a number of reasons, including moderated credit growth due to high NPLs, tighter credit conditions, and corrections in the balance sheets of the banking sector. The disinflation process continued to firm up over the first 2 months of the year, with significant moderation in price pressures. Both headline and core inflation broadly trended down, alongside easing inflation expectations, an indication that the disinflation process remains well anchored. Our latest forecast suggests that the medium-term inflation target of 8 plus or minus 2% is within the forecast horizon, and we are on course to meeting the inflation target band. The committee noted that the current inflation forecast provides scope for monetary policy to realign interest rates, translate the disinflation gains achieved so far to the market, and reinforce the fiscal consolidation process by easing the burden of interest payments on the budget. Under these circumstances, the committee decided to reduce the monetary policy rate by 200 basis points to 18%.
The governor has also been speaking about the takeover of Unibank by the central bank.
I'm not sure if he was very clear on what he wanted, because obviously if they met the capital requirement, we would not have liquidated those two banks. So they did not meet the capital requirements, and they were deeply insolvent. If you remember, it was negative over 100 and something percent. So those banks were completely in very, very bad shape. So now the question from Citibanks that I had said that when I took over, there were 9 banks that were, having difficulties. I went back to that issue because I think it's important to stress that what we are seeing is a legacy problem, right? So that's why we always go back to the 9 banks. It's not us who came and created those 9 banks. We came to meet it. So this is a legacy problem, and a legacy problem arising from so many factors, including the weak economic management. That's part of the legacy problem. So yes, there were 9 banks. 2 had to be liquidated. 1 has been put into administration. And I've just given you the latest state of the banking system, that we think that it's robust. We think that the resilience is improving. I also talked about the fact that the capital adequacy ratios are going up. So there is some effort. The banks are putting in additional effort to raise their capital. That includes the banks that have not been, acted on. Obviously, they must be the ones that are contributing to the increasing resilience that we are seeing.
All right, so you heard the central bank governor. Let's now do some analysis on this particular action by the Bank of Ghana. And with me here in the studio is economist with Data Bank, Courage Marty. Now, Courage, you're welcome. Now, what influenced, he cited the positive outlook on the economy as the main reason why he dropped the policy rate. Now, could you explain what this positive outlook means and what is the impact on me and businesses?
Well, with the understanding that the core mandate of the central bank is to ensure price stability, low inflation. If you recall, in February, the government amended the special petroleum tax from ad valorem to specific tax.
Sure.
What it meant was that whenever price of crude oil goes up on the world market and it translates into higher export prices, the higher effect will be mitigated by the specific tax. Otherwise, it could have been more. So the specific tax makes sure that the impact is minimized. Then in March, you recall again that the PURC reduced electricity tariff for different categories of consumers. This also meant that the cost pressures will further be contained going forward because electricity tariff for utilities are key components of the inflation measure. And so you see that the outlook is very, very favorable now for lower inflation. Of course, the cedi is also quite stable, very strong in recent months against expectations. And all this just means that the inflation outlook is very much improved, and it gives scope for the central bank to cut the policy rate, because we need to do that. Because if you look at the composite index of economic activity, it showed that the economic activity is picking up, but it's still running below potential. And so you need to stimulate it from the monetary side as well. So with lower inflation risk, you just have to cut it to stimulate the growth side of the economy.
All right. So what does it mean to me and businesses in general?
Well, normally you should think that as the rates go down, it should impact on lending rates, so that when you and I walk into the banking sector to get loans, we should contract these loans at a lower cost. But it will not happen immediately, I must emphasize, because there are going to be transmission mechanism it will pass through. First of all, you know that the high NPLs ratio is a key problem. And so until that is resolved, we will not see an immediate pass-through. Now, you need to look at the base rate itself. And there's been concerns about why it is rigid downwards when the policy rate goes down. So the new introduction from April is that they want to introduce what they call the Ghana reference rate, a model designed by the central bank and the Association of Bankers, so that with this reference rate, it will take into account other factors like the treasury bill rates, like the policy rates, like the interbank interest rate itself, and they will weight it. And that will then help a quick pass-through of policy rates to lending rate through the Ghana reference rate.
What could be the pass-through deadline or timeline?
Well, I mean, currently you see the lag is between 3 months to 6 months. So our expectation is that it should reduce it at least from the 6-month lag towards 3 months. Again, it will also depend on the cost of funds, the maturity profile of the cost of funds of this bank. So if you give the bank a fixed deposit that they have to pay you 20% per annum, and that has not matured yet, it will not pass through immediately. So it depends on some of these factors.
Now,
as
we
well.
realize some of the commercial banks have started, reducing their rates already. Now, with this further drop in policy rates, what could be the new rates or the benchmark rate that we should be expecting?
I think we should be looking more towards the base rate and how it moves. And I expect the base rate to move down. I mean, the last publication showed 24% thereabout. I think that there's room for it to come down. So for me, over the next 12 months or so, I'm seeing at least 200 basis points reduction in the base rate. Now, the risk premium is where it is anybody's guess, because it depends on the risk profile of the borrower. And once a risk premium is slapped on the base rate, then you should see the lending rate. But I think that with the base rate or the reference rate moving downwards, then all things being equal, you should see the lending rate moving downwards as well in the coming months.
All right, now, the governor also mentioned the takeover of Unibank and other developments within the banking industry. What do you make of that?
I think the central bank is moving swiftly. And for me, on the contrary, it should give more confidence to the investors that we have a regulator that is not prepared to wait for things, the problems to degenerate. And so the swiftness with which they are moving should give so much confidence to the market. And of course, let me also emphasize that at the start of this asset quality review, and when all these problems started coming up and they identified 9 banks as the ones at risk, there was an emphasis on the fact that these smaller banks account for less than 5% of the total industry portfolio, deposit portfolio. And that basis, when things like this happen, it shouldn't give us the concern that our banking sector is not stable, because the guys that are at risk, the central bank says they account for just 5% or less of the industry's deposit portfolio. So it tells you that they are being ring-fenced so that they would not be transmitted into other areas. So the larger population of the banking sector is still strong. And to also conclude, you will notice that in the latest data that was published, the capital adequacy ratio has actually increased from about 15-17%. It's currently now at 19%. That means that the decision that the banks should increase their capital levels to 400 million is actually being effected by some of these banks. Okay. And so we are seeing the capital adequacy ratio increasing to 19%. Over the course of the year, we'll see that happen, showing that banks are now well capitalized and ready to absorb so much risk as they lend out their capital.
Now, before you go, some capital market players I've spoken with over the weekend mentioned the fact that the frequent announcement by the regulator that the Bank of Ghana is having some impact or a toll on the capital market itself, that's the stock exchange, because in their estimation, the capital market or the industry should be made to react to some of these challenges in the banking sector, and not necessarily the Bank of Ghana governor coming out to announce. They think that is sending wrong signals to investor confidence and things like that. Do you share the same opinion?
If you're talking about the problems with the banks,
exactly.
Right? Well, I think
some of these banks are listed on the stock market as well.
Well, the central bank is aware of the fact that if you also allow this to fester, it could transmit into other banks, right? And the thing is that they give some of these banks the time to correct it. Like the case of Unibank, they were given so much time to correct it. If they kept quiet on it and didn't act, we were likely to see a UT or capital bank scenario with these guys. And so it was only proper that the central bank, of course, the central bank also has the mandate of ensuring stability and depositors' funds are safeguarded. So if there's any threat to depositors' fund, it was only proper for the central bank to communicate it to the market. What you want to be asking is whether it is not possible for all these to be aggregated at the same time and dealt with. But again, you will answer yourself that all the banks are at different stages of solving their problem. And so you cannot just lump them up and say, you are all bad, and so let's announce your name to the market. They are at different stages of their solution process. And that is why we are seeing them one after the other. I believe that as we get into the third quarter, fourth quarter of the year, this issue should be finally resolved, and we should get a banking sector that is robust enough to take off.
Thank you very much for your time.
My pleasure.
And that was economist with Data Bank, Courage Marty. He's been sharing his thoughts on the recent announcement of the drop in policy rate by the central bank from 20% to 18%. This on the marketplace. And moving on, the UK Prime Minister's trade envoy, Adam Efriyi, says he's happy with the direction Ghana is going with regards to government's Beyond Aid agenda. Speaking at a Tech in Ghana conference in London, he also identified many investment opportunities in the country and highlighted the agric industry, where he noted have many opportunities.
It's possible a free flow of investment into Ghana, from Ghana into Britain, a free flow of talent to and fro between the countries, and a free flow of products and services between the countries, because there is no doubt that freer trade is what lifts all the boats. And whether that's here in the West, but I think even more so when it comes to developing nations. And I'm reminded, actually, what the President Nana Akufo-Addo said, both in his inaugural address and in his recent addresses in both Paris and elsewhere, about Africa and Ghana beyond aid. And that's not being rude and saying that we don't want any more aid in Ghana. Of course it's not. What it's about is it's about a vision of Ghana rising through trading, through small and medium-sized businesses, through local employment, through overseas investment, through cooperation. And I have to say that the President of Ghana probably put it more succinctly and with more clarity than we often do here in the West. That actually it's about private businesses driving up the economy as much as it is about governments supporting the infrastructure and supporting the business and investment environment in Ghana. So I visited Ghana, I think, 5 times last year, a similar number of times the previous year, and each time I visit Ghana, I'm really, really enthused. And when we look at the economic performance this year in particular, and when I sense the mood among the Ghanaian diaspora here in Britain, it's quite clear that something is moving on. And I think it's moving in the right direction, and I think the British government recognises it's moving in the right direction, and we will continue to do what we can to support that development. I'm also quite keen to hear of your experiences, which is why I'm going to try and truncate my remarks to make sure there's time to do a quick bit of Q&A so I can get a sense.
Now, on his part, the Ghana High Commissioner to the UK, Papa Uswankuma, urged or used the opportunity to woo investors to Ghana. He touted the gains by the digital address system so far and noted that the future is very bright for the country.
This is on technology, and I believe that digitization or bridging the digital divide is what is going to leapfrog Ghana from its present economic position to be competitors in the global world. So for me, tech startups are key. We have a lot of innovators in Ghana, and they don't have the resources. So when we expand the tech base, I can assure you that, no, we're going to leapfrog. We missed the industrialization. Now, with tech, we have the opportunity of being at par with the developed world. That's why it's so important to me, and I'm so passionate about it. And I believe it's an area where, with proper investment, we are going to get indigenous Ghanaian young people competing globally. You go to Ghana, a lot of the financial institutions tell you that credit is high because they are unable to locate individuals. So they give credit at higher risk. And I'm saying that with the digital address system, it is possible to locate each and every Ghanaian within a 5 square meter space. And that is also critical. And of course, with the national ID and digitization of driving license, etc., identity is going to be certain.
Now, South Africa says it did not sign the Continental Free Trade Area Agreement because it needed more time to study the agreement. The country was also concerned about the huge influx of people instead of goods after it fully commits to it. So far, the two big economies in Africa, Nigeria and South Africa, are not signatories to the Free Trade Area Agreement initialed in Rwanda. Deputy South African Ambassador to Ghana, Tapela Madubani, revealed this at the Ghana-South African Chamber of Commerce breakfast meeting here in Accra.
Your observation is quite right again when you say that there will be those countries that attract and those that push. So there are those who have a pull factor and those who will have a push factor. Well, South Africa, you will be aware, is maybe one of the biggest pull factors in Africa. But that is not on its own. It's not something that we're saying, no, because we have a pull factor, we suspect that we will be overwhelmed by people. No. All that we're doing is to take the agreement back home, democratically engage people, inform them what the CFTA is all about, because we have industries, we have unions, we have people must be consulted. And remember, signing an agreement, how many agreements have been signed and never went into force? It will be useless to sign an agreement which you will not then ratify because you did not consult your people. We want, when we sign this agreement, we are sure that it will not, you will not have court cases, challenges here and there, upheavals, but you are sure that you will be able to also speedily ratify it and make it as part of our laws.
Deputy South African Ambassador to Ghana, ending the show this afternoon. My name is Emmanuel Abuaji. Have a good afternoon.